What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is March 17th of 2023. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, we've got to talk about the next major domino to fall in our global financial system. And more specifically, while Bitcoin is showcasing some very solid strength in regards to price action, its highest level and potentially highest close since as far back as mid-June of 2022, we need to ask the big question. We're not focused on the short-term relief rallies or short-term moves, but whether or not this is the start of the next bull market and what we need to look out for if that is the case, if whether or not Bitcoin can really deviate from the broader asset markets, irrespective of a potential recession. We've got a lot of things to dive into today's video. If you guys happen to enjoy the video, it is my birthday, so if you could consider dropping a like if you're feeling lucky on St. Patrick's Day and you feel like sharing the love. But let's go ahead and kick off this video. It's going to be a jam-packed episode, so you guys won't want to miss this one. All right, so I want to go ahead and just first off again emphasize, as I've talked about, we did a video last time trying to give kind of the devil's advocate perspective, view the other side of the argument, and see whether or not, again, we could potentially be wrong at the end of the day. And again, if you guys saw that video, one thing that we emphasized big time is that I understand where the FOMO is coming in right now. I understand why people are obviously excited when we see Bitcoin breaking above that 200 week as we had here back on March 14th and as we had slightly back here a couple times in February, right? I understand again when we had as well for back here in August, we had a deviation above the typical or normal SMA here, the 200 week, which again moves at a different pace from the 200 week exponential moving average. We had the same kind of optimism that, okay, we're back in, we're in for the next bull market. We came below the 200 week as we typically find bear markets. Now we're back above it. It's time to get optimistic again, right? Well, that's the narrative that a lot of people share. And again, I understand if we take a look at market order flow for the first time, this is our partner tool book map here, which is showcasing real strength on the cumulative volume delta for the first time on a weekly period. As I analyze this quite frequently, we have seen a green flip on the CVD. This is definitely a step in the right direction. But as we've talked about, trend shifts happen when there are consistent weeks of market order flow in either direction. So if we've been on a long-term expansion to the upside in the CVD, as we typically find in a bull market, after we see a couple weeks of continued red pressure or negative cumulative volume delta in bookmap across the multi-book tool, which basically goes over across the order book of multiple exchanges, that can be your early stage sign of a trend reversal to come, the start of a bear market, and vice versa. If we see multiple weeks of this, then this is going to be a step in the right direction. I'm not going to sit here and deny that, guys. We're very consistent about that point. And if we see that, that is going to give a lot of favor to the argument for the bull case. But this is just 1 week after week by week by week by week by week of red pressure. So we need to be vigilant and not move off of simple 1 week positive flips here. All right. It is definitely a good sign to see. It's a step in the right direction. And it could be, again, a sign that we may be in for the thesis we talked about in the prior video. We might get that short-term move up towards the 28-32K band, which was not only a significant price range back here in May of 2022, as well as June and July of 2021 and January 2021. But more importantly, the reason why we are watching this level is because of the Lux Algo price action concepts indicator, which has signaled to us on the daily that this is the next major potential range of liquidity to retest. The price action concepts indicator is going to be giving us an idea of where there was significant price developments considering volume. And more specifically, what's really nice about the indicator, as you can see here, we can see, generally speaking, how much of that order flow was sell side pressure, buy side pressure. And again, as typical with most bear market moves, you're going to find more red pressure here. So we need to see whether or not, as we come up into this range, whether or not we're going to see that same kind of overt distribution and profit taking, or if we've got the follow through to continue another bull market. And that's the real question I think you guys need to be asking yourselves. If you want to trade these short-term moves, yes, perhaps we're going to get a deviation, we move a bit higher. And yes, it may go higher than where we took out our positions into cash back in August of 2022, around $24,000 to $25,000. So be it. What I care about here is preserving and protecting my capital and asking the bigger question: are we in for the next bull market? Are we going to be really setting in new all-time highs? Well, if you aren't asking yourself that question, I think it's time to start doing so. Because while I think there's definitely a chance for Bitcoin to break away and be this kind of hedging asset in a world of growing uncertainty, I'm not denying that here. We've been covering Bitcoin since 2017, and I would love if Bitcoin could serve as that new age digital gold. But I think we need to really step back first and understand what could potentially continue to break in our financial system. So again, I really want to just emphasize though, again, if you guys are interested in these indicators, I highly recommend you guys check out Lux Algo. I'll leave a link down below in the description and a 30% discount code. You guys can also get 20% off Bookmap on your first month. All those data points will be down in the description. But if you guys are not using these tools on the daily or weekly time frame, I feel like beyond just analyzing price action, you're going to get so much more value. They're some of the few indicator suites that we use and tools that we use to look beyond just price action. But definitely consider adding these tools to your arsenal when it comes to technical analysis. But let's go ahead and dive into this bigger, broader macro topic here. Now, I know that we've got a lot of scares going on when it comes in the banking sector. Credit Suisse being one of the major players in Switzerland and a global financial player with a long track record and a long expectation of failing at some point or another, has been nosediving off a cliff after already being on a broader downtrend since, well, back since 2008, pretty much. This has been a bank that the world has already seen as a likely candidate to fail. But what is so funny about this, guys, or I guess not so much funny or laughing matter, but it's just a bit comical, is that as Credit Suisse is falling off a cliff here, we have Credit Suisse's CEO coming out and stating that liquidity is very, very strong. And I think, as you all know from that statement, that sells like someone selling you on something. But more particularly here, right after he stated this back on March 16th, we now know just a day later, after liquidity was supposedly very, very strong at the bank and didn't need government bailouts or assistance, that the Swiss National Bank is now providing the equivalent of $54 billion of Swiss francs. So again, think back to FTX. Think back to all of the crypto companies that said liquidity is strong. You can withdraw your funds. There's no problems. Celsius did the same thing. All these big companies coming out and lying through their teeth that everything is okay, that there's no need to panic. Yet the Swiss National Bank, for Credit Suisse alone, needed to provide $54 billion. It felt the need to approve the liquidity provision of $54 billion overnight. So all those companies out there who are saying everything's fine, nothing to worry about, take a second guess and think whether or not they're telling you the truth. That Credit Suisse is not in potentially big trouble. That the other regional banks, right, are trading at such a lower price, right? We've seen here again with the Lux Algo on the weekly time frame. There's been a clear downtrend, a clear sell signal on the weekly time frame that has not been interrupted. Each and every time we came into the supposed resistance band here on the sell indicator, it's given you perfect short opportunities on the weekly time frame. That's why, again, for me personally, why I really like these indicators, I like to look at them on the weekly time frame. And that goes also for some of our other custom indicators that we share within the Dash report that we utilize to spot trend shifts and swing trade opportunities. This is a major decline. We are back in 2020 territory from the banking collapse we had back then during COVID and the general equity crash that we had during that period of time. And I don't think it's just the regional banks. If you guys think that the contagion and the pain points in the economy are going to stop here, I think you've got another thing coming. And the reason why I say that, I really want to drive this home. And again, we need to really consider the weight and ramifications of these events when it comes to crypto. That is going to let us know whether or not we can really kick off another bull market. The next domino that could fall in our financial system is REITs, real estate investment trusts. Now, you've probably heard about REITs. They became really popular for a lot of dividend investors. It became very popular over the last decade as the real estate boom took off. It seemed like they were a surefire bet. Now, for those who may not know what an REIT is, it's totally fine. This is an investment vehicle that essentially will do one of two things. Either will buy up various different types of properties, basket them into an ETF, and they're ideally focused on income generation, or on the other spectrum, it could be a bundle of different types of mortgages or fixed income bonds of some sort within the real estate market that generate some kind of yield, or generally focus on generating income from renters. Basically, it allows you to be effectively a partial landlord in a whole pool of different properties. That's the way to kind of think about it. You get the vast majority of the income from it. There's some operational costs, of course, for those who run the fund, but generally the vast majority of the returns from these properties are being passed back to the investor. So you're kind of getting the exposure of ownership into either properties or some kind of mortgage basket, and on top of that, you're getting the passive income from those mortgages or from those properties. Now, this on the surface is a totally fine thing overall. I think one of the big problems is that there is going to be a long-term issue of just this everyone can be a landlord philosophy and make money from renters, and everyone can have Airbnbs, and everyone can live financially free. Unfortunately, guys, the people who have been selling you that and telling you that everyone can live that way, and therefore leave us with a major shortage of talented labor in the market, meeting the needs of everyday goods and services that the economy demands, which has been a big reason for this inflation as everyone got really stinking rich back in 2020. I gotta tell you guys, unfortunately, that is not gonna be the case. Not everyone can be a landlord. Not everyone can just sit back and live off passive income. The economy cannot survive like that if we're all just going to be in that position. So I'm just going to really share that with you guys, because I know there's a lot of gurus out there and tell you, oh, you can go out and do this, do that. This is not the time to do it. It was the time over the last decade when credit was easy. But now we are in a contractionary environment. And that comes into our second and more major point here, which is that these REITs, which did really great during a period of easy money, are going to suffer. They are going to bleed. I'm not being dramatic here. It is the reality when we're stepping into a contractionary environment where the Fed is trying to fight inflation. They are now reducing the balance sheet. They are now no longer providing that cushion to asset prices, predominantly in real estate markets. And you can see very clearly as we are seeing how prices playing tango here with the 200-week and 200-day, whereas we were having much higher deviations above that, where we were generally in the past holding above these moving averages. We are now facing resistance, a multi-week decline here over the past month, going in since back in late January, down below the 200-week yet again, similar to where we were back in October. And if we snap below this range where we were back in October, a very consistent support range on Realty Income Corporation, one of the big REIT products, this is going to be the biggest warning sign you need to know as to whether or not we're about to experience our broader recession. This could be even bigger than the collapse of SVB, right? Because SVB, at the end of the day, all the depositors got their money back. The only thing that was really lost is the equity value and the shareholders of that bank. And still, that was a big domino that is going to have weighted effects for the next coming months to come. But if REIT products like Realty Income or VanEck's mortgage REIT income, which again, you can already see here, some of these, they're not all equal. There are some that have better exposure, some that are more exposed, unfortunately, to commercial real estate, which is in the trash right now because people no longer are working back at the office like they used to. There's an overglut in supply and a lack of demand. Generally speaking, there is a variety of different types of REIT products, but even if some of these blow up, where people think they own billions of dollars of assets, and not to mention assets that should be generating them income, when these dividends start to get slashed and the property valuations start to go down after a decade or more of upward moves in real estate values, this is going to lead towards some big capitulation. And again, you can just take a look at the chart, guys. It doesn't look good. And I know a lot of people would be looking at, the dividend yield, say, hey, Nick, it's paying 14% now. Shouldn't be buying the dip. Well, if you're losing on a annualized basis, right? We need to look no further than the annualized timeframes. If I'm losing 35% and I've already lost 7.2% here since January, 3 months, the principal losses of these ETFs, these REITs, are outweighing far beyond what I'm hoping to get in a dividend. Not to mention, those dividends can be cut at any point when they stop getting renters paying. They've got to do that as an REIT, right? And the big domino that I think is going to collapse, and I'm not the only one who thinks this. This has been really becoming growingly prevalent, and people are coming to the consensus that something is about to break in these REITs, is looking no further than Blackstone. Now, this is not BlackRock, the big financial manager. This is Blackstone, a major player in investment real estate, and on top of that, one of the major producers and leaders within the REIT income space. Now, I want to go ahead and already mention that since back in February, we have already had worrying signs. Blackstone paused REIT investors from withdrawing as far back as January of this year. So we have already seen that there was already a demand to outflow capital from these investment vehicles to essentially unload them and get back into cash. Since back in January, the Fed since then has continued to raise rates. And as we'll talk about later on, while a lot of people are convinced of a Fed pivot, it's looking like we're still going to see a higher terminal rate than where we were here. Okay, so if Blackstone was having issues back in January, what's going to happen here in March or April or May? How bad has it gotten here now with the liquidity crisis where people want to withdraw their funds? They can't do this forever. This is really going to spell bad news for the market, because if not them, someone else will offer that off-ramp, as we are already seeing in other assets. Someone will capitulate and cover for potential losses. And that's just going to put Blackstone and its investors in deeper water. There's no way to just escape it or just forget it. And there are other property plays like Medical Properties Trust. Again, take a look here at LuxAlgo on the weekly, sending a strong sell signal back in February. And yet again, lower highs, lower lows, not even coming up to the resistance band or those moving averages. Medical Properties Trust, again, another play that a lot of people are excited about. It's paying 14.4% dividend, a multi-billion-dollar REIT owning medical properties and commercial facilities, now looking like it's yet again heading into the trash. We do not want to bet on these plays during a risk-off period of time. And if anything, if you want to try to place bets on these companies, do it at much more capitulative levels than this, right? Look for traditional alignments. The last bear market in 2009, we saw this go all the way down to $2 to $3 a share. Don't think that it can't do the same, guys. Don't chase the dividends. There's so many people who tell you, chase the dividends, buy dividend stocks, get passive income. It's not passive income if the money you are putting into it is losing more value than the dividend. It is a trap. You're getting caught in a liquidity trap if you do that, guys. I'm only here to tell you that. I have no financial benefit. I'm not promoting that you guys use my referral links and go buy some stocks on Robinhood or go trade on leverage. I'm here to help you guys preserve your capital. And to think that even if just 2 or 3 of these big REIT entities go down, that it's not going to be a big deal. This is tens, if not hundreds of billions of dollars of real active liquidity in the market being drained. It is going to crush investor sentiment, because these were the kind of plays that people could bet on during the last decade that were relatively resilient, setting higher lows and higher highs, paying a nice dividend. Now setting into serious trouble. Now, I want to go ahead and talk about the point here, which is that, okay, Nick, we've got all this stuff going on in the financial system, but isn't bad news kind of good news? Doesn't this mean that the Fed is going to step in and play alongside the Bank of Japan and the People's Bank of China in introducing new liquidity? I know some of you have been pointing that out over the past few months, and trust me, I'm listening, I'm watching it, and I understand, as many of you probably have heard by now or probably assumed, that the Fed has practically stepped in with $300 billion of silent quantitative easing as a response towards providing liquidity for depositors, aiding alongside the FDIC, and trying to help alleviate some of the stressors within the banking industry right now. And while the Federal Reserve is definitely doing this here, the big thing I want to drive home, while we have been seeing this potential slowdown in QT and expansion of the balance sheet, well, this is something we need to watch, and we are definitely watching the global supply of liquidity, which has been expanding here. All right, the big thing you guys need to watch are bond yields. Plain and simple. The bond market is going to give you the best indicator what the Fed is going to do next. And while it is definitely pricing in less rate hikes since back on March 9th, when we started to see what was going on at the regional banks in the United States and how risk is potentially starting to really play out in the financial sector. At the same time, if we hold on this 200-day, we just push sideways or moving up, I would not be long risk assets. And even on top of that, even if the Fed goes down here, I really want to emphasize this point. The good news equals bad news argument, guys, it is not going to play out like it did in 2020, where there's this V-shaped recovery even if the economy was stagnant and stuff. That was a very big anomaly in some of the biggest liquidity injection. We doubled the money supply effectively over 2 years. We are not going to see the Fed do that. They're going to do enough to try to soften the blow a bit, but that does not stop us from entering into a recession and entering into a broader correction of 40 to 50% across major assets and equity markets. What do you think crypto is going to do during a period of time like that? I don't want to speak in absolutes here, guys, right? There's always a chance I could be wrong on this, but you come here to this channel to hear my opinion on things, and hopefully one that is grounded in a lot of facts and a lot of different data points. And I got to tell you guys, even if the Fed, again, if we go to the United States Central Bank balance sheet, right? Even if the Fed starts to just flatline here on its balance sheet, that doesn't prevent equities from moving lower, all right? And on top of that as well, even if it starts to expand it a little bit, you think it's just going to be able to really go on some other major run-up in an inflationary environment? If we are still experiencing right now on the CPI, 0.3% month-over-month expansion. We experienced 0.5%, the biggest expansion since back in June. Or on the PCE, back in January, it was 0.6%. Do you think the Fed can inject any serious amount of liquidity? Let's go ahead and talk about those scenarios, because some people, again, have really tried to make that argument that the Fed doesn't have to care about inflation or it can't keep fighting inflation. It's got to worry about the financial system now. Okay, I'll play devil's advocate. Let's go ahead and play with that scenario, right? So the Federal Reserve steps in, injects a lot of liquidity. They flatten interest rates and potentially start lowering them sooner than expected. So be it, right? What do you think that's going to do to inflation? Inflation right now is already at 0.6 to 0.3% on an average month-over-month basis. You can kiss all this progress goodbye, and we are going to come back to 1.5% month-over-month expansions in inflation. Sure, there will be some months where it cools down, maybe it's not as heightened, but you are going to get those kind of rapid expansions. And what is the Federal Reserve going to have to do? They're going to come back even harder. Inflation is not something that you can just shove into the closet and forget. I know some people, again, as we've talked about before, have said, oh, the Fed's just going to change their metrics for inflation. It's the new norm. Yeah, it's going to be the new norm until we realize we've got to do something about it. Because unless you want it to be like in the early 1900s, in Germany, where again, inflation is rampant and you lose entire trust in currency and in the bond markets and the trust of governments and central banks to manage monetary policy, that world is not going to be a beneficial one for asset prices or for anyone for that matter. And I know that at the end of the day, the Federal Reserve has to deal with inflation. I can tell you guys that with 100% certainty. Maybe they decide to do it later. Maybe we get some relief rally, but it's not going to be enough to sustain a full-on bull market. And I would say as a point of inspiration here, before we dive into the close on Bitcoin, right, we can take a look at the Dow Jones back in the 70s. And this is, again, I think the best case scenario for the bulls overall. We're going to go ahead and bring here the weekly so we can really take a look at the long-term trend. This was the lost decade, right, between the 60s and going into the 80s here. Actually, it's about 17 years where the Dow Jones went practically flat, right? And sure, maybe there's the opportunity like we saw here for us to revisit back to those all-time highs, even maybe have a deviation in all-time highs for a little while, like a very brief move. But do you guys really think like we're going to have a continuation of the last decade where it's just up and to the right? Equities in the longer term, right? Really long term, they do this. They do move up in accordance with inflation and the base money supply increasing, and as innovation and the economy grow. But we are not in a high growth phase, guys. And we got to stop trading. We got to stop thinking that way, that it's just going to be good times, right? The Fed's going to save us. The Fed cannot save us. And the Fed, whether it kicks the can down the road and has to come back even more aggressively, it can also do the right thing. It can continue to increase interest rates a bit more, keep them suspended, not touch the balance sheet, and let some of these banks fail with the FDIC and other different means coming in to save depositors. For the uninsured participants, unfortunately, for those who have millions of dollars, you're going to face a haircut, having it in the wrong bank or institution. Tough luck. So long as everyday Americans have their savings in their bank account, this is the type of liquidity contraction we need. If this money just keeps floating around and we tell people, oh, you everything is insured, everything's all good, there's no mistakes here, keep doing what you were doing over the last decade, it's just going to get worse. And inflation will have not been dealt with. And that is going to hurt the end consumer more than anything, because there is more aggregate demand in the economy than existing supply. So I know, guys, sorry, a bit of a negative message on my birthday and stuff, but I just want to be real with you guys on this. And to, again, come back here towards the close, talking about Bitcoin. Now, I, again, want to come back to this point about Bitcoin as an asset, and I understand you guys are feeling really optimistic here. I definitely have to say that this chart right here, the Bitcoin to NASDAQ ratio, is what has got me most excited. Seeing that we've been able to get above the 200-week and 200-day moving averages is definitely a really positive sign. But as we saw here back on the last trading day, right, we faded a lot of those gains. I got to see that it can hold up here, because according to history, when we get up in this range, it doesn't last here very long, right? And we are in a macro environment that, for a more risk-on asset like Bitcoin, where its on-ramps are being talked about in question when it comes to regulators shutting them down, we have the banking infrastructure around these assets crippling as we speak. Where is that liquidity going to come from? I'm not saying retail volume and speculators and just general investors, long-term hodlers can't drive it up. But we haven't even seen the typical correction of a typical crypto bear market. I just don't see how Bitcoin is going to do very well in this environment. And until we start seeing a more continued deviation of Bitcoin away from the NASDAQ, where it's continuing to lead, I can't be too confident on it just yet. The risk to reward isn't there, guys. And sure, maybe I'll miss out on some gains. Yeah, maybe I didn't pick the absolute bottom. I'm fine accepting that. But when the trend shows me enough signs of confidence, I will let you guys know. I'll be as honest as I can with you guys. I'm going to be here during bull and bear markets to let you know what I'm thinking. And I'm going to try to share with you guys not only my thesis for how I approach things, but the tools and resources like Luxago, like Bookmap, that can give you that additional edge in the market. To look beyond simple price action, looking at those longer term time frames. This is the kind of mentality, the kind of hedging, protection of capital mentality that is going to help you survive bear markets. Because anyone can make money in a bull market. It's about whether or not you can preserve those returns and wait for the next run up during bear markets. Because so many people will lose everything, fooling around with leverage, chasing opportunities, chasing relief rallies, trying to fight inflation. Inflation, expect it to be baked in. If you made a lot of money over the last decade, like a lot of other people, inflation's a symptom of it. Not everyone is a millionaire, so to speak. That's the kind of general thesis I would preach here, right? I'm not saying that you guys have $1 million net worth or anything. It's more of an analogy here. Everyone got stupid rich in 2020. There's no other way to put it. I'm just trying to be candid and blunt with you guys. And if you guys like that kind of candidness and bluntness here, if you guys enjoy the kind of content we put out, please, if you guys could, for my birthday, consider dropping a like and share this video with family members or friends who you feel it might be relevant for. Until the next video, though, guys, I hope you have a wonderful weekend. Have some time away from the charts. Don't get too caught up in all the mania. I don't think there's going to be any issues with everyday people getting their money from banks. There are protective layers like the FDIC, all these systems in place, but it may not be the time to really get long assets. It might be a time to focus on not what you can make, but what you could potentially lose, and doing everything to protect that capital from being lost. So, have a wonderful rest of your day, guys. Have a wonderful weekend as well, and I'll see you all in the next video. Take care, everyone.